And good afternoon. Thanks for joining us. Welcome to today's Options Play webinar. And the topic for today is vertical spreads, credit versus debit spreads. My name is Scott Green, Marketing Director with Regal Securities, and shortly I'll be introducing the main presenter of this Options Play webinar series, the expert Tony Zhang. This is the sixth webinar we are doing covering options play. Today we'll be going over what are vertical spreads, comparing debit and credit spreads, debit credit spread management. Tony will show live trading examples and more that we're excited to show you. Options Play, for those who are not quite familiar with it, is a highly integrated options tool within your trading platform. It helps you with the options analysis, strategy, and research for trading options. And after I introduce our presenter, Tony, he'll then go over the Options Play tool within the trading platform, and then the debit versus credit spreads. And then at the end, we will have time for Q&A. It's about an hour long, this webinar. Last 15 minutes or so we dedicate to Q&A. If you have any questions at any time, please just submit in the chat box your questions. So now I'll just take a moment to share this disclaimer. The types of securities, forms, and research tools used in this webinar are for demonstration purposes only and should not be considered a recommendation by Regal Securities or a solicitation or an offer to buy or sell any options. This webinar is being recorded and is not intended to be used for individual tax, legal, or investment planning advice. So with that being said, I'll now introduce the expert in options play, Tony Zhang, who is the chief strategist there. Tony has over 12 years of experience in the financial services industry. He oversees the development team over at Options Play, and the team has led the development of some very innovative tools in options trading and analysis. The tool is currently embedded with several major sell-side brokerage firms, as well as a direct-to-consumer platform. And Tony himself helped build up the product suite and bringing it to market, and he has developed and managed many of Options Play's partnerships. And so right before Tony begins, just want to show everyone on your trading platform where you can find Options Play. Just right here across the top, there's a tab if you want to open it up as you follow along. If you have any trouble finding it or locating it, please contact your customer support team of your broker and they'll be able to assist you. So now I'll let Tony take it over.
Thank you, Scott, and thank you everyone for taking the time out this afternoon. Welcome back to our webinar series. Today we're going to be talking about trading debit versus credit spreads. We're talking about this because this is by far the most popular complex option strategy you can take. It is a great strategy to allow you to apply a directional view for any underlying stock or ETF, and allows you to do it with limited risk. And it's one of the more efficient ways that allow you to take a directional view with limited risk. So we really want to talk about these two strategies. And what I really want to highlight is the fact that these two strategies are actually very, very different, even though on the surface they look quite similar. Just one seems like one's a debit, one's a credit, and the other, and vice versa. But there are some distinct differences between the two, not only in how you should utilize them and when you should utilize them, but more importantly in how to enter and exit these types of strategies. So that's really what I plan on going over with you guys here today, is understanding the use cases of each one, understanding the differences between these two strategies, and how to go about managing these debit versus credit spreads. I'll try to spend as little amount of time as possible using the slides. What I want to spend as much time as possible is actually showing you these two strategies side by side so you can see some real world examples to help you better understand when to apply debit spreads and when to apply credit spreads to your trading. Like Scott said, my name is Tony Zhang. I'm the chief strategist here at Options Play. This webinar is recorded, so as you follow along, if you need to come back, you can always come back, watch the recording. So don't go off looking at other screens and things like that, because you'll be able to have the recording to come back to and reference later. This webinar is for both beginners and advanced traders or experienced options traders. But before I start, I just want to ask a quick question. If you could type into the chat window, yes, if you have traded debit or credit spreads before, or no, if you have not, just so I get a feel for who's in the room. Looks like I have a pretty good even split between yeses and nos, which is great. So for those of you that have traded, I hope you guys learned something more about the difference between vertical spreads, specifically debit versus credit spreads. And for those of you that have not, I hope this helps inspire you to take a look at these types of strategies, because they are one of the better ways to take a directional view, regardless of whether your directional view is a strong directional view or not a very strong directional view. One of these two spreads can be useful. So hopefully this helps you understand these spreads better so that you can actually start utilizing them in your trading. So today we're going to go through something very simple. Number one, what are vertical spreads for those of you that are brand new and have never traded one before. For those of you that have, we will talk about when to trade them, because that's actually one of the most important things to understand. Then we'll talk about how to trade vertical spreads effectively. This really comes down to understanding when you should apply them and when you should not, and more importantly, the exit and the entry and exit rules around these types of strategies to give you the best possible returns using these types of strategies. And like I said, what I really want to do is spend most of the time showing you these two trades side by side so that you can really see the difference between the two using the Options Play tool, which is what you guys all have access to free of charge as a Regal customer. So I highly recommend you to take a look after we finish using this tool so that you can structure these two spreads next to each other and definitively know which one's best suited for you. So I'm going to start off real quick explaining what are vertical spreads for those of you that are brand new and have not traded these types of strategies. I've broken down these into two different strategies. I have debit spreads and I have credit spreads. Both of them allow you to take both bearish and bullish views on any underlying stock. So when we're trading a debit spread, the bullish is a bull call vertical, the bearish is a bear put vertical. Now, you don't have to memorize this. I'll show you these in more detail in a second. On the credit spreads, it's basically the exact opposite. You would trade the bull put vertical as the bullish trade and the bear call vertical as the bearish trade. Okay, so let's break these down into what they actually mean. How do you actually structure them? So the first thing you should know about trading vertical spreads, and this is really why this is one of the most popular complex option strategies, is that you have a predefined risk and reward before you get into a trade. That means you know exactly what your potential risk is, what your potential reward is. It makes it much easier to plan out your trade. Conversely, if you just buy a call or a put, you know what your risk is, but you don't know what your potential reward, because you have unlimited reward when you're buying a call or a put. With the vertical spread, because it's predefined, it makes it much easier from a money management perspective. So here what I have is an example. It's a fictitious stock of XYZ stock, and it's trading at $100. And I want to walk you through those four different strategies that you trade. So when we're talking about a debit spread, this is referring to a spread that requires a debit to enter the trade and then a credit to exit that trade. So when we're talking about a bull call vertical as a debit spread, what that really means is you're buying a 100 strike call or an at the money call. And what you're going to do at the same time is you're going to sell a higher call, a 110 call against that. So you're buying an at the money call that's costing you X amount of money, and you're going to sell a higher call that's going to bring in less credit. That's why the net is going to be a debit. A bear put vertical is the exact opposite. You're basically buying a $100 put, meaning an at the money put, and at the same time you're going to sell a $90 put against it, so a lower put. And what that does is is a debit, because you're paying more for the $100 put than you're receiving in the credit that you're going to get from selling a $90 put. So those are the two debit spreads that you can trade that are both bullish and bearish. On the credit side, it's basically the exact opposite. And I know this gets a little tedious and a little confusing. So for those of you that are brand new, hang in there. I'll explain a little bit more as we get along. Credit spreads are simply spreads that you receive a credit up front to enter the trade, and then you have to pay a debit in order to exit the trade. So a bear call vertical is basically the exact same strikes as a bull call vertical, but what we're doing is we're flipping the sells and the buys. So instead of buying a $100 call and at the money call, you're going to sell the 100 call, and then what you're going to do is you're going to buy back the 110 call. So this allows you to take a bearish view on a trade using calls, and bull put vertical is the exact opposite. You're doing the same strikes as you are here on the bull put vertical, but as the bear put vertical, but on the bull put vertical, what you're going to do is the exact same strikes, but you're going to flip the buys to sells. So here we're going to sell the 100 put, the at the money put, and we're going to buy back that lower put, that $90 put. Okay, so that's how you structure these debit spreads versus credit spreads, just so you have an idea as far as how they're structured. Now, you don't have to memorize this because the platforms do all of this for you. We actually have constructors that actually construct them for you. You don't have to memorize which one's higher, which one's lower. It all does that for you on our platform. This is just for illustrative purposes for those of you that are brand new to get a feel for what debit spreads are and what credit spreads are. So let's actually talk about the difference between the two. Now, before we can break down what are the differences between debit versus credit spreads, I want to point out a key fundamental understanding that we need to all have when we're trading options. No matter what type of options we trade, we need to understand that all option strategies is simply a trade-off between risk to reward and probability. What I mean by that is that if you have strategies that have high probability, they will always have a low risk to reward. Vice versa, strategies that have high risk to reward will always have low probability. So there's always a trade-off between the two, because I hear a lot of people asking me, how do I just find strategies with high probability? And you can certainly do that, but what you're doing when you're doing that is you're only looking at half the picture. You want to know how well balanced the two, think of it as a seesaw. You want to make sure that those two sides are balanced. If you have an unbalanced where you have really high probability on one side, it's likely you're going to have very, very poor risk reward. Sometimes that risk reward even offsets the high probability. So understanding the trade-off between probability and risk reward is the first fundamental piece to understanding the difference between these two strategies. So when I break this down, debit spreads, what's different about debit versus credit spreads is that debit spreads traditionally or typically have what we consider lower probability of profit. So you may have 40% of your trades are winners and 60% of your trades as losers. And that sounds really bad. No one wants to have less winners than losers. However, the flip side of that is that it typically has high risk reward. So you're risking a small amount of capital, maybe $50, to try to make $100. So here in this example, I have a 2-to-1 risk reward ratio. So I'm risking, or my reward is twice as large as my risk. So that is generally the characteristics that you would see when you're trading debit spreads, is lower probability of profit with higher risk to reward. Credit spreads, on the other hand, are the exact opposite. They tend to have higher probability of profit. So you may have 80% of your trades being winners and only 20% of your trades being losers. And that always on paper sounds really good. However, the flip side to that is that these type of strategies will have low risk reward. So you're risking a substantially more money than the potential reward that you're going to collect. So here's an example where you might be risking $150 just to try to make $50. So this is a risk reward of only 1 to 3. So you're risking 3 times the amount that you're potentially making. So the question is kind of which one's best? Which one should you trade? And the answer is that there isn't one that's best. It really comes down to personal preferences and understanding how well balanced these two are. So personally, when I trade, I prefer to risk less money to make more money, and I'm okay accepting less winners. Other people just prefer to have more winners, and they're okay with risking more money when they're wrong. So there's no right or wrong, there's no better or worse. It really just comes down to sometimes personal preferences. And in the next slide, I'll talk about when you should utilize them, because that also helps determine whether you should use a debit or credit spread in your trading. Okay, but so it's important first just to understand the fundamental difference or the trade-off that you have between probability and risk to reward. So what I have on the next slide here is just a snapshot of what it kind of feels like to trade debit versus credit spreads, okay? Because we've talked about the trade-off between probability and risk to reward, but what does that actually mean for your trading? So what I have here is a series of trades. So it gives you an idea as far as what it feels like to be a debit spread trader versus what it might feel like to be a credit spread trader. So debit spreads, like I said, have lower probability with better risk to reward. So what that translates to is less winners with bigger rewards. So here I have 5 trades here, and this is the characteristic that you typically see of debit spread traders, meaning you have less winners. So out of these 5 trades, I only have 2 winners. So only 40% of my trades are winners, and 3 of those 5 trades are actually losers. But as you can see in my winners, I'm winning more money than I'm losing when I do have a loser. So the net comes out to a total profit of $50 after these 5 trades. That just gives you a feel for what it feels like to be a debit spread trader. So more of your trades may be losers, but the ones that are winners tend to outweigh the losers that you have. Vice versa, on the credit spread trader side, you are more likely to have more winners with smaller rewards. So here I have same thing, 5 trades, and 4 out of those 5 trades were winners, which sounds really good to have meant a lot of winners. However, as you can see, that one trade that was a loser wiped out basically 3 of my winning trades. So the net result is still the same. I'm still making the $50 profit at the end, but there's just a different way of arriving to that similar amount of profit. So I don't want to put this in your head as to one's better than the other, but they are fundamentally very, very different when it comes to trading. So me personally, I don't love the idea of wiping out, most of my gains in a single trade, wiping out the gains from the previous 3 trades on one single trade. I personally prefer to risk less money and try to make a higher reward when I'm correct, but that's a personal preference for me. Each one of you are different, so I just want to highlight the difference between the two so that you guys can kind of help make a decision for yourself. So let's talk about when you should actually trade debit spreads. Now that we've talked about the difference between the two, let's talk about when is the best time to apply a debit spread versus a credit spread. And because they are very different in nature, you don't want to apply them the same way. So debit spreads are very useful when you expect a large and quick move in one direction or another. So this is typical for those of you that are, many times people that are reading the charts and looking at chart patterns, they may be identifying a breakout on a trade, or perhaps it's bouncing off of a support or resistance level, a rebound off of a support and resistance level. This is where you expect the stock to make a quick and fast move in one direction or another. That is usually the best case scenario to leverage a debit spread, because it's going to give you the best risk to reward with limited amount of risk if you're wrong. And these are typically strategies used in lower volatility environments. Credit spreads are a little different. Credit spreads are better suited when you expect a neutral or modest move. A lot of times, this is useful for those of you that are using technical analysis, especially for those of you that like to use the indicators such as stochastics, MACD, RSI, any of those type of oscillators that tell you overbought or oversold conditions. Those are typically good times to utilize credit spreads, because when a stock is overbought, what that's telling you is that it's unlikely to continue going higher. So that could mean 2 things. The stock can move lower, or it can just kind of move sideways, meaning it doesn't continue going any higher. So this is what I'm talking about, expecting the neutral or modest move. That's typically when you want to deploy a credit spread. So again, I will go through some real examples to show you guys these so that you can actually better understand when it's best to use debit versus credit spreads. And credit spreads, generally speaking, are better used in higher volatility environments. So I just want to do a quick illustrative example here. I have a stock here, and what I want to illustrate is when you should consider trading debit spreads. I have here a breakout where a stock was trading within a range, and it was kind of creating this triangle. And right here, it kind of broke out above that range. And at that point, you kind of expect the stock to really rally off of a breakout. So this is the best time to utilize a debit spread because it allows you to take advantage of a bullish move on this particular stock with limited risk, but still take full advantage of a quick and fast move in one direction or another. Okay, so very, very simple. When you expect the stock to move in a quick move in one direction or another, debit spreads is typically going to give you the best risk to reward and a better return if you are correct on your trade. Vice versa, kind of on the same chart here, if let's say you have a chart that's kind of moving sideways or a stock that's kind of oversold and overbought, oversold and overbought, as you can see here, I have a stochastics indicator here at the bottom. I've identified all these different points where the stochastics was telling us the stock was overbought or oversold. These are, as you can see, the moves after the stock was oversold wasn't moving very much. It moved from about 101 to 102 to 103, barely touched 103. So these are very small, modest moves. You're simply saying that I think the stock has hit a support or hit some kind of level where I don't think it's going to continue going further down. That's when you want to initiate a credit spread. Same thing on the upside. When the stock is overbought and you think the stock's not really going to go much higher, that's also another time to initiate a credit spread. And again, the difference is that you don't think the stock's going to make a big move in one direction or another. That's when you want to use a credit spread. So making sure that you understand the difference between the two is absolutely critical to making sure that you're applying the right strategy to the type of analysis that you're doing on the individual chart. So let's talk about how to effectively trade debit spreads. So we've talked about what the difference between debit and credit spreads are. We've talked about when you should consider utilizing them. Now let's talk about the entry and exit strategy. So the entry strategy we just spoke about, we want to time a debit spread when you expect a large move. Very simple. Doesn't matter whether it's a breakout or it's a bounce off a support level. However you like to use your charts or identify your buy or sell signals, you want to time the entry of your debit spread with when you expect a large move to start materializing. And the exit strategy is also actually fairly simple. And this is really one of the reasons why I like to trade debit spreads, because the risk management or the exit strategy of a debit spread is a little easier and cleaner, especially for those that are starting out. It's a little easier to manage because when you're trading a debit spread, you generally want to cut your losses if the move simply doesn't materialize. So in the example I gave up here before, if I'm expecting this stock to break out, and it kind of breaks out but doesn't really move anywhere after a few weeks, that's really a good time to say, hey, the move that I was expecting, it didn't materialize, so it's time to cut my losses and move on. And the goal of a debit spread is almost always to exit before expiration, meaning you almost never hold the debit spread to expiration. You will always exit the trade either at a gain or a loss prior to expiration. Now, when should you consider cutting your losses and when should you consider taking profits? On a debit spread, it's pretty straightforward. You should consider cutting your losses if you've lost 50% of the amount that you've paid for that spread. So if you paid $1 for that and it's trading at 50 cents or less, it's time to consider cutting your losses. On the flip side, taking profit, you should consider taking at least partial profits if you made at least 75 to 100% gain on that spread. So if you've paid $1 for a spread, if it's trading at $1.75 or $2, that's when you should at least take partial profits. So if you're trading multiple contracts, take a piece of that off, take some profits, and you can always leave on a few contracts left if you think the stock's going to continue going in one particular direction. And if you're only trading one or two contracts, you should just take full profits. So this is a pretty straightforward rule of thumb for when you're trading debit spreads. Very easy to remember. 50% loss, cut your losses. 75 to 100% gain, start taking profits. On the credit spread, the entry is also very simple, very straightforward. Like we talked about, you want to time your entries when you feel that the asset, the stock or ETF has kind of reached the top or bottom, or traditionally what you might call oversold or overbought. And there's many different ways to measure overbought or oversold, but indicators like RSI, MACD, stochastics are the more popular ways of doing that. So what you simply want to do is you want to put on a credit spread, you want to put on a a call credit spread if you're bearish, a put credit spread if you're bullish, and you want to time these with these tops and bottoms. And what you can do with credit spreads is you can actually string puts and calls together. So what I mean by that is in this scenario that I gave here, you can actually sell a put credit spread when you feel it's oversold, and you can sell a call credit spread when you feel it's overbought. Even if that put credit spread hasn't even expired yet, you can actually sell a call credit spread up here. And you can actually string them together. So here, as you can see, I've sold a call credit spread here on this particular date, and just a few days later, I felt the markets were oversold now. I can sell a put credit spread here. Even though this trade up here on the call credit spread I've sold is still open, I can sell a put credit spread down here, and I can string these along together. So, and that's really why credit spread traders tend to be more frequent traders. You're collecting small amounts of premium here and there. And if you're wrong, meaning if, let's say I sold a put credit spread here and instead of going higher, the stock drops, that's when I have significantly larger losses or significantly larger risk than what I'm collecting on selling that call credit spread or put credit spread. So you generally you can string these puts and calls together. So this is really where credit spread traders tend to trade more than debit spread traders. Now, when it comes to exit strategies, this is where it gets a little trickier, because when you're trading credit spreads, the goal here is to simply sell the spread for a credit, meaning receive the credit, and then hold on to that spread until expiration, where it becomes worthless. That means you keep all of that credit for yourself. However, that doesn't always work out, meaning sometimes the stock doesn't go in the direction that you want, and you have to start thinking about mitigating your losses, because you can potentially risk 2, 3, 4, 5 times the amount of money you've received on that credit. And that can wipe out a lot of the gains that you've received over the last 4, 5, even 10 trades. So it really becomes critical to manage your risk when a trade starts to go against you on a credit spread. Now, this is where it gets a little trickier, is because when you decide to cut your losses is dependent on how much credit you've received. And what we do is we look at how much credit you've received, meaning how much premium you've received, based on the width of the spread. So in the example that I gave in the very beginning, where the stock is trading at $100 and we're selling a $100 call and buying a 110 call back, because there's a $10 difference between the two strikes, that the width of that spread is a $10 width. So what you want to do is calculate how much premium are you receiving with respect to that width. So if it's a $10 spread, how much are you receiving? Are you receiving 20% of that or more? So $2 or more on a $10 wide credit spread. If that's the case, you want to cut your losses if you've lost anywhere from 75 to 100% of your premium or the credit that you've received. If you've received less than 20% of the vertical width, so if, let's say you only received a dollar credit on a $10 wide spread, then you want to cut your losses where you've lost anywhere from 100 to 200% loss on that trade. So this is really where it becomes a little trickier to manage, because it depends on how much credit you receive, and how much credit you receive is simply a factor of how far away that credit spread you're selling is to the current price of that stock. So it's just a little bit more complicated when it comes to managing a credit spread. So I always tell users who are starting out, start with a debit spread before you trade a credit spread. Get a few debit spread trades under your belt so you get an understanding of how they work, how the prices of them get affected by the stock moving in the underlying, and then move on to trading credit spreads, because they do involve a little bit more knowledge of trading spreads before you should start looking at trading credit spreads. So now that we've understood the difference between debit versus credit spreads, we've talked about the different use cases, and we've talked about a little bit about how to manage them once you've gotten into this trade, when you should exit this trade. Let's actually look at some real examples so that we can put what we've learned here to real use here. So what I have here is, here is the options play tool. For those of you that do not have access to it or have not seen this, you can access it through your Regal account. There's a link, a tab here in the upper right-hand corner called Options Play. This is a tool, it's free of charge to all of you. I highly recommend you to take a look. This was designed because we realized that when you're looking at an option chain, sometimes things like how to compare a debit or a credit spread is not something that's very intuitive from looking at a chain. Conversely, even if you knew which debit spread to trade, how much risk do you have? How much reward do you have? What's your break-even numbers? How do you compare one spread to the other? You couldn't do all of that from just looking at the chains. And that's really why we created Options Plays. We wanted to give all of you a visual way to look at different strategies side by side and actually compare them visually and say exactly which one's best suited for you. And that's what I'm going to walk you through here today. So the platform itself is divided into 3 sections. We have trade ideas and watch lists here on the left. We have our security analysis panel here in the middle, and then we have trading and income here on the right. So we call these 3 panels the what, the why, and the how of stocks and options trading, because what symbols should you look at? Trade ideas provides you with fresh ideas every day. Your watch list is symbols that you want to watch. The security analysis panel is designed to give you quick snapshot data so you can quickly gauge a directional view on the underlying stock. We recently just did a webinar on how to utilize our technical score and our trend indicators to give you a directional edge. I highly recommend, if you've never seen that webinar, to take a look at that recording, because it's really going to help you gauge the directional view for an underlying stock. And then once you have that directional view, how do you actually take advantage of a bullish or bearish move on any stock? That's really when trading and income comes into play. So trading is what we're going to spend our time here today, because we want to compare trading, different stocks, trading options on different stocks when we have a directional view. So I have a few different stocks here that I want to take a look at. These, like Scott said in the beginning of the webinar, these are not by any means a solicitation to trade these securities. I'm simply using these for illustrative purposes to show you the difference between debit or credit spreads. Please do not take this as a solicitation to trade any of these specific securities. So I have Home Depot here. This is a relatively strong stock. As you can see, a technical score of 7, telling me this is a stock that's outperforming the overall market, and the 1-month and 6-month trends are bullish, telling me not only is this a strong stock, it's continuing to, the trends are showing that it's continuing to strengthen. So let's take a look at some bullish views on Home Depot. So recently I saw that Home Depot had a pretty good run. As you can see, the trend indicators turned bullish here on April 26th. And the stock has run up to about 201 here in mid-June, and then is really kind of pulled back towards the end of June, right near this 195 support level. So there's 2 ways that you can sort of read into this. You can either think that this stock is pretty strong, it's just consolidating a little, and I think it's going to continue moving higher now. Now, very similar to the pullback it's had here, where it reached a high of, let's say, right here is around 192, took a few weeks to pull back, and then had a pretty quick move up higher. This is exactly the type of moves that you would typically want to see if you were trying to trade debit spreads, right? So I think it's fair to say that it's possible that you would think that this is just a small consolidation period, of which afterwards it's going to rally up to maybe 210 over a fairly short amount of time. That's one way you can view this. The other way you can view this is simply saying, hey, 195 is a support level. It's pulled back to that level. It's a strong stock. It's in a bullish trend. I don't know if it's going to continue going higher, but I certainly don't think it's going to go much below 195. So those are the 2 different views that you can take. One will allow you, you should take a debit spread. One, you should take a credit spread. So let's actually put the 2 side by side. What I'm going to do is, as you can see here, when I click on the I'm bullish button, I get 3 strategies. I can buy the stock, I can buy a simple call strategy, or I can buy a call spread. Now this defaults to the debit spread here. So I have an August 17th 195 210 call spread. And what I'm going to do right now is I'm going to remove this call. I'm going to replace it with a credit spread. So I'm going to use our strategy constructor. I'm going to select a bullish trade. I'm going to do the short put vertical, because that's going to be the credit spread on a bullish move. So let's take a look at, the stock's trading at 195. So let's say I sell a 195 put, an at the money put, and then I buy back a lower put, a 190 put. Let's put the 2 side by side and actually, let's take a look at these 2. Now, before I do that, as you can see, one I'm going to receive a $180 credit for, one it cost me $528 debit for. So before I kind of compare these two side by side, I want to first calculate the appropriate number of contracts. And we have a contract calculator here. So I can say I want to risk, let's say $2,000 on this particular trade. Once I click on that, what it tells me is that I can sell 6 contracts of this call vertical, and I can buy 3 contracts of the debit spread. As you can see, my max risk here is roughly the same. So here it's actually a little less. So let's say I can do 2,500. It's just so I have a much closer comparison. So if I'm willing to risk 2,500, then I can sell 7 contracts of the credit spread, which makes my max risk $2,200. I can buy 4 contracts of the debit spread, which makes my max risk $2,100. So these two have almost identical amounts of risk. So now let's actually compare the two and see what the difference is. So I'm going to use the P&L simulator. This is by far the most powerful tool that we have here, especially for those of you that are newer to options and have never traded a credit spread before, or a debit spread, or any spreads. The P&L simulator really allows you to understand the different scenarios and see which one's best suited for you. So here, Home Depot is at 195 right now. So what happens if between now and expiration on August 17th, Home Depot goes nowhere and it stays at 195? As you can see, if the stock stays at 195, this strategy here in the middle, the credit spread, gives me that full 100% return, because the credit spread allows me to take advantage of a neutral or modest move. So here, if the stock doesn't move anywhere, the credit spread actually gives me 100% profit, or allows me to keep the entire $1,200 credit that I've received on this particular trade. If I bought this debit spread, I'm actually losing pretty much all of my money. I'm losing $2,016, so 95% of my money. So this is where it goes to show that if you don't think the stock's going to move very much, you should trade the credit spread. You certainly should not be trading the debit spread. If, however, you think the stock's going to move higher, you think it's going to go up to, let's say, 200 or 205, right? Then you can take a look at what happens if the stock goes up to 205. Here, I make I'm still going to make that $1,200 because that's the most amount of money I can make on my credit spread. But if I traded this debit spread, which again has the same amount of risk, I'm going to make $1,800. So even if the stock moves modestly higher, about $10 higher, I'm going to make a much higher dollar profit on my debit spread than I will make on my credit spread. Conversely, if I think the stock's going to continue moving higher to 210 or and any higher, as you can see, that's really when this debit spread starts to truly outperform. I'm going to make almost a $4,000 profit versus only a $1,200 profit when I'm trading the credit spread. So again, credit spread is good if you don't think the stock's going to move anywhere. You're going to receive that full credit. But if you're correct on your direction and it moves really a lot, you're not going to make any more money on the credit spread. But if you trade the debit spread, you're going to make substantially more money as the stock continues to move higher. And one of the reasons that we put a slider on our P&L simulator is that we wanted to not only show you what the difference between the two strategies are, we want you to be able to play with where the stock goes and see exactly at what point does one strategy start to outperform the other. So as you can see here, around 203, that's when this debit spread starts to give you higher profits than the credit spread. So here I'm going to make a $1,300 profit if the stock goes up to 203, and only a $1,200 profit if the stock goes up to 203. So the question you can ask yourself is, do I think the stock's going to go above 203 or higher? If you do, then you should consider trading the debit spread. If you don't think it's going to go above 203, then it's probably better to trade the credit spread. So as you can see, if I break this down, as you can see on the debit spread, I'm risking roughly the same amount of money, $2,100 versus $2,200, but my max reward here is $3,800 versus my max reward here is only $1,200. So even though I'm risking the same amount of money, I'm making almost 3 times the amount of money on a debit spread than I'm making on the credit spread. So understanding the difference between these two, understanding what scenarios are best for each one is very, very important to making sure that you utilize the right strategy for your trading. Let's take a look at another example here. Let's look at let's look at Tesla. Tesla is another bullish example. Maybe I'll try to find a bearish example after this one. But as you can see, it's trading at 345 right now, a very popular stock amongst traders. So a few different ways to interpret this. Very similar to Home Depot, had a very nice run over a short period of time from right when the trend. So as you can see, our trend indicator turned bullish right here on June 1st. So this would have been a great time to consider trading a debit spread. But let's say you missed all of that, right? And recently it pulled back from that 370 high back to around 325. And it's starting to bounce a little higher. So again, two ways you can view this. You can think that the stock is going to continue going higher to 390 or higher, or you simply just say that you think that it is pulled back to 325. You might go a little higher, but you mostly think it's going to kind of stay sideways, but you don't think it's going to go below 325. So again, let's take a look at trading that. So I already have here the debit spread, an August 17th 340 by 415 called debit spread. Now I'm going to modify the strategy here in the middle. I'm going to change it to a credit spread. So again, I'm going to select bullish, short put vertical. That allows me to look at buying some, or let's say I sell a 340 put, and then I buy back a 315 put, so a lower put. And then again, let's say I'm willing to risk $2,500. So as you can see, I'm going to risk $1,500 versus $2,400. So let's change this a little bit more. Let's say that I'm willing to risk $5,000. So if I'm willing to risk $5,000 here, then I can sell 3 contracts of the credit spread, or I can buy 2 contracts of the debit spread, giving me almost the identical amount of risk. One's $4,500, one's $4,800. But as you can see, my max reward here is only $2,900, or about $3,000 on the credit spread. My max reward on the debit spread is $10,000, more than 3 times the amount of potential reward on a credit spread. Okay, so let's take a look at the different scenarios that I talked about. It's trading at 342 right now. What happens if the stock just stays exactly where it is, around 340, right? So if the stock stays around 340, here I make the full credit. I receive the $2,900 that I've sold the credit spread for. I get to keep all of that if the stock stays where it is. If I bought this debit spread, I'm losing most of my money. I'm losing 81% of my money. I'm losing $3,900, right? So again, if you don't think the stock's going to move, debit spreads are not the way to go. Your credit spread's going to be a much better scenario. But if you think the stock's going to move significantly higher, so if you think Tesla's going to, relatively strong stock, telling me it's outperforming the overall market, it's got 1 month and 6 month trends that are bullish. So you might think that this stock's going to continue going higher. Let's say you think it's going to go to 390. So if the stock goes to 390 here, like I said, no matter what happens, if the stock goes higher, the most amount of money I can make is the credit that I received. So here's about $3,000, $2,970. But if I traded the debit spread with the same amount of risk, I'm now going to make $5,100 versus only $3,000. So even if I think the stock's going to make what I would consider a fairly modest move by Tesla standards, I'm going to make substantially more capital or return on my debit spread versus my credit spread. Conversely, if let's say I'm completely wrong, I'm going to risk the same amount of money on each one of these 2 trades. So if let's say Tesla collapses and goes back down to 300, as you can see here, I'm losing $4,500 because that's my max risk. Here I'm losing $4,800 because that's my max risk. So I'm risking the same amount of money for these 2 trades, but depending on where I think the stock's going to go, I'm going to make vastly different returns. So when I really think the stock's going to take off, right, to 415, I'm going to make roughly a $10,000 profit here on the debit spread versus only a $3,000 profit on the credit spread. So depending on how bullish you are on the stock, that helps you determine which strategy is best. And you can always use our slider to see at what point does one strategy start to beat the other. So right here, it's around 380. So it's telling you at 380 is when this strategy starts to outperform this strategy. So you can also ask yourself, do I think the stock's going to hit 380 or higher? If you do, then you should trade the debit spread. If you don't, you should consider trading the credit spread. So with that, that's just a quick summary of the difference between debit versus credit spreads. Making sure that you understand that the trade-off between probability and risk reward is extremely important in understanding when you should deploy these. And also just having a fundamental understanding as to what are the different scenarios as to when credit spreads are better than debit spreads is really important, because that allows you to utilize these appropriately. Because when you do expect a big move, you're going to get a substantially higher return on the debit spreads. If you don't expect a big move, the credit spreads is going to be a much better trade for you to place. But if you expect that big move and you trade a credit spread, you're not going to be able to take advantage of that while risking more money than what you're going to receive in that credit. So with that, what I'm going to do is I'm going to open this up for Q&A. If you have any questions, please type them into the chat window. I'll be able to answer as many questions as I have time for. So here's a question here. Where are the webinars available? Scott, I believe, just sent out a link, eoption.com/optionsplays, where you can find a list of the recordings. How do you, I have a question here from Karen. How do you know the second column is credit spread and the third column is the debit spread? Great question. So as you can see on our screen, the cost here is a negative number. That's how you know it's a credit. And here on the trade cost, it's a positive number. That's how you know it's a debit. So the trade cost on a credit will always be a negative number. A debit will always be a positive number. Steve's asking, does options play take into consideration volume and open interest? And the answer is no, because volume and open interest doesn't affect how I select my strikes at all. If you're concerned about liquidity, if that's what your question means, you should hit the trade button, because what we have is a strategy checklist, and one of the things that we check for is spread and liquidity. So the bid-ask spread is a much better way to gauge liquidity of an option. So the difference between the bid and the ask price will give you a much better sense for whether something's liquid or not. Volume and open interest many times can be, but it's not absolute. So that's why we always use the bid-ask spread, and we use that to gauge liquidity versus open interest and volume. Can you compare assignment risk of each trade? Great question. What do you mean by compare assignment risk of each trade? Because your risk of assignment is really contingent upon when you hold on to that trade, not when you enter that trade. And really the only time you have risk of assignment is a dividend on a short call spread. There's a few different scenarios, but with American style options, even though you can exercise early, the risk of that is relatively low. So that's why we always sell credit spreads that are out of the money. A lot of people will say, why don't you trade this debit spread as a credit? And the reason for that is because if I traded this as a credit, then what's going to happen is I'm going to have much higher assignment risk because I'm selling a way in the money put. That increases my chances of assignment. So there's nothing that you can do to really see what your chance of assignment is, because that is fairly random. So I don't know how you would analyze that, but that's why when we sell credit spreads, we always sell out of the money credit spreads, so you have a relatively lower chance of assignment. But there's no way to actually put a number to what your chances are. Question from Tori. In the chart, do the support and resistance lines adjust the movement of the stock price? Yeah, so every single day we recalculate these support and resistance lines. They're recalculated once a day. So as stock prices update, if they break through support or break through resistance or form new support and resistance levels, you'll see them recalculate every single day. They generally don't change very often, but they can change up to once a day. Hans, it's eoption.com/options play. Scott, if you don't mind sending that link out to everyone again, that'd be great in the chat window. I have a question here that says, one question's asking, Ron's asking, how do you set the bull credits, all the different spreads up? So again, you don't have to memorize them. We have a strategy constructed that actually does them for you. So you can do a long call vertical, short put vertical, or for bearish, you can do a long put vertical or a short call vertical. Verticals are just these spreads. Our strategy constructor actually construct them for you. And Ron, that's a great question, but I don't think it's the best use of our time to actually go through them manually over the phone or over the webinar. I think it's best that you call up your account rep and they can kind of walk you through each one of these 4 spreads and how they're actually constructed. And I'll send this this slideshow to Regal Securities so that you can actually see how to construct the bull call vertical, bear put vertical, and each one. Let's see. I have a question here. In the debit bull spread, if stock is moving in right direction, while the call you bought is making money, you're losing money on the call you sold. So how can you make money? Oh, great question. So the answer is the amount of money you're making on the long call is not the same proportion to the money you're losing on the short call. So for example, if the stock moves higher, you're going to make more money on the long leg than you're losing on the short leg. That's how you make money, because the delta on your long leg is much, much higher than the delta on your short leg. So the amount of money you make for every dollar the stock goes up on the long leg is significantly more than the dollar amount that you're losing for that same move on the short leg. That's a really good question, but that's how you make money. Can you see the order book for an option or a stock? I'm not sure what you're referring to as far as that goes, but that's a question for Regal Securities. We are not a order book. We are just simply showing you the analytics of each specific trade. In what situation would you consider closing one leg while the other leg is still running? That's really a much more advanced question, and I don't know that I have enough time to get into that. It really is when you expect that the stock to really take off and you don't want to be capped on that short leg. That is one way you can consider getting out of the short leg, because you can only really close out the short leg, because if you close out the long leg, then you're left with this short leg with unlimited risks, and that's generally not something you want to do. Karen's asking, I've used the options play to buy options, but can you refer it for validating a time to sell your options? Yeah, so that's exactly what we're talking about here, right? Is when you're trading a debit spread, very easy to manage your money. You should cut your losses if you've lost 50% of the premium you've paid, or take profits if you made 75% gain on your trades. On a credit spreads, a little trickier. It depends on how much premium you receive with respect to the width of the vertical. So if the amount of premium you receive is greater than 20% of the width, then you want to cut your losses at 75 to 100%, or if it's less than 20% of the width, you want to cut your losses when you've lost 100 to 200% losses. As far as taking profit, the goal really is to allow that credit spread to expire worthless, so that you keep all your credit. I hope that answered your question, Karen. Steve's asking, when are the support and resistance calculated during the day? They're calculated at about 6 p.m. at night. So after the close, once we process all historical data for the day, they get recalculated at around 6 p.m. Eastern time every day. Should you look for 1 month out options for both the strategies? So generally speaking, most people will trade options that are between 1 to 2 months out. I've generally found that credit spread traders tend to trade slightly less time than debit spreads. So for example, on this Tesla example, maybe if you're trading credit spreads, maybe you might not trade the August 17th, but you would maybe trade a weekly that's 1 or 2 weeks prior to that. So maybe you might trade the August, let's say July 27th or the August 3rd. So we tend to see credit spread traders are about 1 month out. Debit spread traders tend to trade about 1 to 2 months out. So they're all in the same range, but we do find credit spread traders tend to trade about a couple of weeks shorter in terms of expirations. Karen's asking, I think, very similar question. What about expiration date for spreads? Are those variable at your discretion like simple options? Absolutely. Just like simple options, when you're buying a call or a put, you generally trade them in the 1, 2, possibly 3 month range. Some of you like to trade leaps, but that's a completely different strategy. Most short-term speculators are trading 1 to 2 month, and that's what we typically would trade with the debit spread. The debit spread is really very, very similar to buying just a call or a put. The credit spread is very similar to selling a cover call or selling a put, just that you don't own the underlying stock, so you have to buy back that further out of the money of call or put to reduce your risk. So that's the best way to think about this. So when you're selling cover calls, you're selling calls 1.5 months out. When you're buying calls, you're typically buying 1.5 month, maybe 2 month calls. So those are the ways that you would think about expirations when you're trading debit versus credit spread. How do you exit either type of spread? It's the same way. They're all either a buy to close or a sell to close order on your spread. For those types of questions, please contact your broker. They'll be able to help you, walking you through the actual mechanics of exiting a debit spread or a credit spread. Steve's asking, do you always look at a daily chart? Personally, I do. You're obviously free to look at any time frame chart you want. You want to look at weekly charts or minute charts, you can do so. I look at daily charts because options is not something you typically would day trade. So looking at the minute charts usually isn't valid because you might have a move that only lasts a few hours. Options is not suitable for that type of short-term trading. Options is really more so for trades that last anywhere from at least a few days to anywhere from, it can be as long as 6 to 9 months. So if you want to do long-term trades, you can look at weekly charts, but for the most part, I only look at daily charts. Any other questions? Just a quick question, actually, for those of you that a bunch of you answered yes to trading debit or credit spreads at the beginning of the webinar. If you could just type in debit versus credit, depending on which one you prefer to trade. Type in debit if you prefer trading debit spreads. Type in credit if you prefer trading credit spreads, just so I get an idea as far as kind of who here in the room likes to trade what. Got a lot of debits here, a few credits so far. So Steve, no, we do not have shorter time frame charts on our platform. Again, because short-term charts are not suitable for options trading. So if you're looking at 5-minute charts, you should not be trading options. You're better off trading the stock itself if you're looking at very short-term trades. Okay, so it looks like there's a fairly even mix between debit versus credit. I hope you guys have found this webinar useful and better understanding the difference between the two. Like I said, they are very different from each other. A lot of people tend to think that they're very similar, but they're not. They're very, very different from each other. It's really important to understand the differences and understanding when you should utilize one versus the other. The P&L simulator we've created really helps you identify the different scenarios so that you can set up a debit versus credit spread and actually see which one you should actually trade. Any more questions regarding what we've spoken about here today? Is it okay to select different expiries on the legs? If you're talking about one leg versus another, absolutely, you can certainly do that, right? But that's where we get into more complex trading because it is a little bit trickier to manage a spread that have multiple expirations because you have to figure out, if one expires, and what happens to the remaining leg. Or if one gets called away or exercised, what happens to that remaining leg? It just becomes a little bit more difficult to manage. But from a theoretical perspective, it's very similar. Just from a mechanical perspective, it becomes more difficult to manage. What is the risk to get the stock put to you? So that's really kind of when you're selling these put spreads, you have the risk of having this really comes down to if the stock is trading below your strike price at expiration, you have the same risk as just selling a put. But that's why we want to trade these spreads, because then you can always exercise the other leg to deliver those shares if you need to, versus if you're short a put, you have to actually end up owning that stock. So this is a discussion that you should also have with your broker about these types of scenarios. And that's personally also one of the reasons why I prefer trading debit spreads, because I have less risk of either owning the shares or having to deliver the shares. When you're trading credit spreads, you have a much higher risk of that. So if you're concerned about exercise risk or concerned about having to deliver shares or buy shares that you don't have the money for, that's really why debit spreads may potentially be a better trade for you versus credit spreads. How to add MACD to your chart? Great question. So you simply click on this little expand button here, right here above your chart. That will bring up a button that says studies, and you can actually add the MACD right here. to your chart. Next time, can you set stop loss order, please? So that's something that you can talk to Regal Securities about, as to how to set up a stop order. That's something you can do with your platform. Options Play is here just to help you analyze when to enter the trade. Any other questions? I wouldn't say high-priced or low-priced stocks are better. It really doesn't matter. It's just that when you have high-priced stocks, you generally have more granularity in the strikes, meaning each strike is a smaller percentage apart from each other. If you have a low-priced stock, the difference, if you have a $10 stock, the difference between a $9 strike and a $10 strike is roughly a 10% move. Versus a $1 strike on a $100 stock is only a 1% move. So the higher strikes, a higher dollar stocks will give you more granularity. So you're likely going to find strikes that suits you better than a very low price stock. It's sometimes just more difficult to find the right strikes. But it's not like one's better than the other. Paul's asking, do you like the RSI or certain stochastics? So this is one of the things that I addressed on the last Directional Edge webinar, is that it really doesn't matter which one you use. I've been a market strategist for about 15 years now, working with clients from all different types of strategies. And what I've consistently found what works for people is not which indicators you use, but how consistently you use those indicators. So if you're going to use RSI, use RSI. Don't use RSI today and stochastics tomorrow and MACD the next day. That's when you get inconsistent results. It's not like one's better than the other. It really just depends on how consistently you apply one indicator. I think that's all the time that we have here for today. Again, thank you everyone for joining me this afternoon. I really hope you guys have found this webinar informative and useful. And I hope this really helps inspire you to start taking a look at debit and credit spreads for those of you that have never traded it before. And for those of you that have, I hope you found a little bit more insight in helping you decide exactly when it's best to utilize each one.
Yeah, thank you, Tony. Really great stuff on the debit and credit spreads, and lots of great questions. Thanks for going through all of them. And thank you to all those who attended today's webinar. If you have any more questions, please contact the customer support team of your broker. We will be sending out an email with the recording of this webinar, and it'll be posted on the website. And just as a refresher, you can find Options Play in your trading platform across the top. Again, if you have any questions, please contact your broker support team. And lastly, our next webinar will be on a Monday, July 9th, so after the holiday week. We'll be on a Monday, just a little bit different that week. We usually do Wednesdays, but it'll be Monday. It'll be at 3:15 Central Standard Time, our usual time, and we'll be sending out information as far as topic and registration for that. So thanks again, everyone, and I hope you all have a great rest of your day. Bye-bye.